Your 401k doesn't fall 40% just because the market falls 40%. Most of it does, sure, but some portions barely budge. And for roughly 11% of the people watching this right now, a 40% market crash could actually turn out to be the single greatest financial moment of their entire adult lives, provided they don't sabotage it. That's the kind of information the fund industry will never print in a brochure. And over the next few minutes, I'm going to walk you through the precise calculations that prove it. Americans held $10.1 trillion inside 401k plans as of December 31st, 2025. A 40% drop happening tomorrow would erase $4 trillion in a single day. To frame that properly, that's a figure larger than Germany's entire gross domestic product vanishing from retirement accounts before you've even finished your first cup of coffee in the morning. And here's the critical detail that most people completely overlook. How much of that $4 trillion actually affects your retirement has almost nothing to do with the size of the decline itself, and almost everything to do with one specific variable that almost nobody discusses: your position on what I refer to as the departure board. Picture an airport departure board in your mind. You know exactly the one I mean, that large board displaying all the upcoming flights. Some flights are leaving in 12 minutes. Others aren't scheduled until early the next morning. Now imagine a storm suddenly rolls in and grounds every single flight by 2 hours. For the traveler who has a connecting flight in 45 minutes, that delay completely destroys their journey. For the traveler who isn't flying until 6 in the morning, that same delay means absolutely nothing. They don't even register it, they're relaxed at the bar. Same storm, same 2-hour delay, and yet completely opposite outcomes based entirely on where each person sits on that departure board. Your 401k in a 40% market crash operate on exactly the same logic. I'm going to demonstrate that using actual numbers. And then I'm going to reveal why the departure board metaphor contains a hidden trap that even financially savvy people stumble into. Because the delay itself isn't the real problem. How you respond to the delay is where most people actually destroy their wealth. In a few minutes, I'll share a number that genuinely unsettled me when I first encountered it. A number that explains how two people can retire with identical 401k balances, get hit by the exact same crash, and end up with completely opposite financial situations 2 decades later. But first, let me explain why a 40% market decline is essentially free money for one very specific category of investor, and why the financial media never brings it up. Generation Z currently carries an average 401k balance of $13,500. Millennials sit at $67,300. Generation X is at $103,952. Let's focus on millennials and the earlier segment of Generation X. You're somewhere between 30 and 45 years old. You've been putting money in for a few years. You've built up a meaningful balance, but you also have 20 to 30 years of future contributions still ahead of you. A 40% market crash hits your account. Suppose you have $100,000 in your 401k. That becomes $60,000 essentially overnight. And here's exactly where the math transforms into something almost nobody explains with any clarity. Every single contribution you make following that crash is purchasing shares at a 40% discount. Your payroll deduction doesn't care that the market crashed. It arrives like clockwork every 2 weeks, automatically buying more shares. You become the person who walks into a store the morning after a 60% off clearance event and gets to shop at those prices for months, potentially years. The 2008 financial crisis was genuinely one of the best developments that could have happened to 25-year-olds who kept their 401k contributions running without interruption. Their money was purchasing shares at 50 cents on the dollar that were worth $4 or more by 2024. The investors who panicked shifted everything to cash and halted their contributions, locked in permanent losses, and missed the entire recovery. Fidelity found that savers who started with $100,000 stayed fully invested in equities, kept contributing, and rebalanced annually between 2022 and 2025, ended up with $191,463. The saver who moved completely out of stocks and stopped contributing entirely would have finished with only $105,586 by the end of 2025. Same starting amount, same 3-year time frame, an $86,000 difference simply because one person panicked and the other treated the decline like a discount opportunity. This is where things get genuinely interesting, because the departure board has a dark flip side that nobody on financial social media will explain. It's uncomfortable, and uncomfortable content doesn't generate clicks. Stay with me here because this next section fundamentally changes the way you think about crash timing. The year is 2026. There's a man I'll refer to as Marcus. Marcus is 61 years old. He has been contributing to his 401k consistently for 33 years. He's built what feels like an impenetrable foundation. The average total retirement assets for Americans in their 60s sits around $1,228,196, though the median figure lands closer to $568,000. Let's place Marcus at the median, $568,000. He's planning to retire next year. He has a specific date in mind. His wife has a specific date in mind. They've discussed it at length. His daughter's wedding is scheduled for October. Everything is perfectly aligned. The market drops 40% tomorrow. Marcus's account falls from $568,000 to $340,000. $800 within a single day. He loses $227,200 on paper. The critical question is what Marcus chooses to do next. Here's the harsh reality that most financial advisors tend to gloss over because it's uncomfortable and it leads clients to question the entire system. You assume the problem is the crash itself. The actual problem is what happens the moment you begin making withdrawals from a portfolio that just took a major hit. This is known as sequence of returns risk, and it is the single most underestimated concept in all of retirement planning. Not because it's intellectually complex, but because it's psychologically difficult to face head-on. Sequence of returns risk refers to the very real danger that poor market performance during the early years of retirement can permanently damage your portfolio. Once withdrawals begin, losses become far more harmful because you're selling assets at depressed prices, while simultaneously having less capital remaining to benefit from any eventual market rebound. Let me give you two scenarios built on identical numbers because this is where things become genuinely unsettling. Retiree A and Retiree B each have $1 million. Both withdraw $50,000 annually. Both earn the same average annual return across 30 years. The only difference is the sequence in which those returns arrive. Retiree A enjoys strong years first and encounters the crash late in retirement. That retiree finishes with more than $3 million after 30 full years of withdrawals. The retiree who faces negative returns in the early years and then recovers sees the entire portfolio completely depleted by year 27. Same average return, same annual withdrawal amount, $3 million versus absolute zero. The only variable is when the bad years occur. This isn't a theoretical exercise. Consider a retiree who began retirement in 1966 with a $1 million portfolio allocated 40% to stocks and 60% to bonds. Despite averaging an impressive 9.5% annual return from 1966 through 2000, this individual would have exhausted their money before reaching age 90 under the 4% withdrawal rule. The reason was that weak market performance combined with high inflation during the early retirement years severely depleted the portfolio. Even the powerful bull markets of the 1980s and 1990s couldn't compensate for that early damage. A 9.5% average annual return, and the money still ran out because the sequence was completely wrong. By the way, go ahead and subscribe if you're getting value from this content. Otherwise, the platform's algorithm may simply stop surfacing these videos to you. Now you're probably thinking, wait, I've been told the 4% rule is the gold standard of retirement planning. Financial advisors have repeated it like gospel for 2 decades, and now I'm telling you, it failed a real retiree despite nearly double-digit average annual returns. Yes, that is precisely what I'm telling you. The 4% rule is the most confidently repeated piece of flawed, conventional wisdom in all of personal finance. If a retiree starts with $1 million and follows the 4% rule by withdrawing $40,000 in year one, a 30% market decline would shrink their portfolio to $660,000 by year end. That 34% reduction severely compromises the portfolio's ability to recover, even when markets eventually rebound in following years. Continuing to make withdrawals from a reduced balance raises the probability of depleting the account entirely, illustrating precisely how early losses can undermine what should have been a sustainable plan. And that's a 30% drop. Now imagine what a 40% crash produces. Let's run the actual numbers. You retire with $1 million. The market drops 40% the very week you initiate withdrawals. Your account is now $600,000. Your 4% withdrawal still equals $40,000. But now that $40,000 represents 6.7% of your remaining balance, not 4%. You've instantly violated your own withdrawal rule without altering a single thing you had planned to do. The mathematics have rewritten themselves beneath your feet. And here's the element that should make you genuinely uncomfortable about the current environment. Despite significant market volatility last year, particularly during spring 2025, the average 401k balance climbed 11% to $46,100, representing the third back-to-back year of double-digit gains. 3 consecutive years of double-digit growth heading into 2026. Every departure board looks excellent right now. Every account statement looks encouraging, and that is precisely the moment when sequence risk becomes most dangerous, because the higher your account has risen on paper, the more catastrophic the timing if a crash arrives at exactly the wrong point on that departure board. Here's something that never appears inside a retirement calculator. You can watch this entire video, absorb every number I've presented, and still not change a single thing about your approach. That gap between understanding and action is where retirement wealth gets destroyed. Recognizing that a risk exists and constructing a systematic defense against it are two entirely different things. I spent considerable time building and studying retirement data before I could develop an actual framework around it, not simply understand the problem in the abstract. I put together a digital book called The Exit Code. It's 8 chapters of analysis built on 50 years of genuine retirement data. Not personal opinion, not broad general principles, but the specific mathematical conditions under which portfolios survive long-term versus get completely depleted. Given everything we've covered about sequence of returns risk, 2 sections will be especially relevant for you. The first covers the dynamic withdrawal method, which replaces the static 4% rule with a system that adjusts your withdrawal rate based on what the market actually does during your first 5 years of retirement, not what it was theoretically expected to do. It's the difference between a fixed rule written in the 1990s and a living, adaptive system calibrated to actual real-world conditions. The second covers what I call the lazy portfolio construction, the specific asset allocation that has historically outperformed active traders across 30-year windows, including through every significant crash since the 1980s. Not because it's aggressive, but because it's specifically engineered to survive the departure board problem at every stage of an investing lifetime. The book draws on 50 years of data. You can access it for less than the cost of a single dinner out through the link in the description. Every year you delay running this math, the numbers compound against you. That's not a sales pitch. You've just witnessed the sequence risk figures yourself. Now here's something I want you to sit with before we move forward, because there's a secondary storyline here that most people ignore until it's already too late. Go back to Marcus, $568,000, planning to retire at 62. But here's the piece of Marcus's story I left out earlier. In 2023, Marcus took out a 401k loan to help cover expenses surrounding his son's wedding. $40,000. The loan is being repaid through automatic payroll deductions. That $40,000 is no longer sitting inside the market. It's parked outside the account, earning absolutely nothing, while the market climbed steadily throughout 2024 and 2025. And because the loan balance represents funds sitting outside the account at the moment the crash arrives, it doesn't benefit from buying at lower prices the same way new contributions would. Data from Bank of America shows that approximately 2.3% of participants carried an outstanding loan against their retirement account by the close of 2025, with average loan balances of $9,300. That might sound modest, but layer in the psychological dimension. Because the loan repayment flows through payroll deductions automatically, Marcus doesn't feel it as a monthly burden. He doesn't recognize it as part of his overall risk exposure. And that blind spot is precisely the kind of vulnerability that compounds when a market crash actually arrives. Marcus's story doesn't end at the crash itself. We'll return to him. But first, let's talk about the decision that has destroyed more retirement wealth than any market crash in recorded history. There's a fascinating psychological phenomenon that occurs during the first 3 to 5 days following a steep market decline. Researchers describe it as a reverse application of the availability heuristic. You've watched your account statement shrink by a figure large enough to feel almost physical. And the human brain, which is remarkably poor at probabilistic reasoning, begins treating the most recent information as the most reliable predictor of what comes next. The crash feels permanent. The eventual recovery feels purely theoretical. And that's exactly when people pick up the phone, call their broker, and say the two most expensive words in retirement history. Sell everything. This move has a name, and that name is the most costly mistake in American retirement planning. Missing only the 10 best trading days across a 20-year period cuts annualized returns from 10.5% down to 6.2%, according to JP Morgan research. And 7 of those 10 best days occurred within 15 trading days of the 10 worst days. Read that one more time. 7 of the best 10 days in a 20-year window happened within 15 trading days of the 10 worst days. When you panic, sell, and retreat to cash, you haven't avoided the crash. You already lived through the crash. What you've actually done is miss the recovery. You sit in cash through 7 of the best trading days of the next 2 decades, and then you buy back in later at higher prices once your fear subsides. Which means you bought at elevated levels, sold at the bottom, and missed the strongest trading days of the cycle. You've executed every single move that academic finance literature explicitly warns against, and you've done them in precisely the order that inflicts maximum damage. Here is the consistent pattern from every major crash since 1987. Every single crash has eventually recovered to new all-time highs without a single exception. Recovery time, measured from the lowest point back to the prior peak, has ranged from 5 months during the 2020 COVID crash to 86 months following the 2000 dot-com collapse. The average recovery period across all 5 major crashes is approximately 41 months. 5 months on one end, 86 months on the other. That's an enormous range. And here's the cruel irony embedded in that range. The COVID crash recovered in 5 months partly because the Federal Reserve deployed an extraordinary level of monetary intervention in a manner that may not be available or applicable in the same form during the next significant crash. The 2020 recovery is a historical outlier, not a reliable template. The S&P 500 declined roughly 34% from peak to trough between February 19th and March 23rd of 2020, then rebounded sharply and reached fresh highs within the same calendar year. That speed was genuinely unprecedented. Building your crash response strategy around that timeline is like planning a cross-country road trip on the assumption that every single gas station will be fully stocked and operating at 2 in the morning. So what does a realistic 40% crash actually look like inside your specific account? Here is the part you've been waiting for. Let's break the departure board into 3 distinct groups with real numbers attached. Group 1 is ages 30 to 45. You have between 20 and 35 years remaining on the departure board. Fidelity reported that the average 401k balance fell 19% between the fourth quarter of 2019 and the first quarter of 2020, during a period when the broader market dropped 34%. Notice the difference. A 19% account decline on a 34% market drop. Why? Because most 401k accounts at this age carry a mix of equities and fixed income that partially absorbs the impact. Most accounts in this age range hold roughly 2/3 of assets in stocks or stock-based target date funds. Bonds cushion some of the blow, but history confirms that sharp declines still occur. So a 40% market decline for a 35-year-old holding $100,000 in a 401k with roughly 70% equity exposure produces a loss of approximately $28,000. That account moves from $100,000 down to $72,000. And then here's the crucial element. Every single paycheck contribution made from that day forward is purchasing shares at a meaningful discount. If you're contributing $500 per month and the market is down 40%, you are effectively buying what previously cost $500 for just $300. Vanguard's 2025 data confirms that participants who stayed the course through multiple downturns saw balances grow an average of 10% annually. For Group 1, a crash is genuinely a gift wrapped inside a terrifying account statement. Group 2 is ages 50 to 58. You're in the middle of the runway. Enough time ahead to recover, but not enough to be careless. A 40% crash lands differently here. Mid-career employees between 45 and 54 experienced significant 401k losses during 2008, ranging from an average 18% decline for those with 5 to 9 years of job tenure to 26% for workers with 20 to 29 years on the job. The longer your tenure, the larger your account balance, and the harder you feel the crash in absolute dollar terms. Someone carrying a $400,000 account in this age group could lose anywhere from $72,000 to $104,000 in a year, resembling 2008. Here is the thing nobody in this age group wants to hear. You have adequate time to recover, but only if you don't touch the account. Research on 401k participants approaching retirement, those aged 56 to 65, showed average balance changes during the 2008 crisis, ranging from a positive 1% for short tenure individuals to losses exceeding 25% for those with more than 20 years of tenure. The people who suffered the largest absolute losses were exactly those who had accumulated the most, because they carried the heaviest equity exposure and the largest balances. The portfolio becomes simultaneously your greatest weapon and your most exposed target. Group 3 is ages 59 and older, either already withdrawing or on the immediate verge of doing so. This is where a crash becomes genuinely dangerous. Not because the percentage decline is any steeper, but because the withdrawal engine is already running. Imagine explaining to someone who retired last Tuesday that the market collapsed 40% last Thursday. This is where the real threat emerges, and it isn't the number printed on your account statement. Withdrawing from a 401k before age 59 and a half triggers a double penalty, ordinary income tax applied to the full withdrawal amount, plus an additional 10% early withdrawal penalty. But the concealed cost runs even deeper, representing decades of lost compound growth. However, Group 3 is typically already past 59 and a half, so the 10% penalty no longer applies. Many people in this group believe they've avoided the worst of it. They haven't, because the genuine punishment for Group 3 isn't an early withdrawal penalty at all. The real punishment is being compelled to sell shares at crash-level prices simply to cover monthly living expenses. You don't have the luxury of waiting years for the market to heal. You need cash this month. Your mortgage payment is due. Your health insurance premium, which for anyone who retires before age 65 and before Medicare eligibility is already staggeringly expensive, is due. So you sell. And when you sell at crash prices, those shares are permanently gone. When you extract income from a portfolio that has already absorbed a devastating hit, you're forced to liquidate even more shares at rock-bottom valuations just to generate the cash you require. This is no longer a paper loss. You are permanently locking in those losses. Worse, you're dismantling the very engine that was supposed to fund the next 20, 30, or even 40 years of your life. The shares you sold at a discount can never participate in the market's eventual rebound. Now, here's the critical point I promised you earlier. The number most people use to evaluate their retirement readiness is their 401k balance. Marcus looks at his account and sees $568,000 and tells himself he has $568,000. He has never actually had $568,000. That figure is entirely pre-tax. Every single dollar withdrawn from a traditional 401k is taxed as ordinary income. Someone in the 12% federal bracket loses approximately 27% of each withdrawal to combined taxes and fees. At the 35% bracket, nearly half of every withdrawal flows directly to the IRS. So Marcus's real number, his actual spendable wealth, falls somewhere between $350,000 and $460,000, depending entirely on his tax circumstances in retirement. Now that Crash has reduced the nominal figure by 40%, which translates into a real purchasing power loss that is even more severe because the tax obligation is applied after the crash has already occurred. Marcus doesn't simply lose 40% of $568,000. He loses 40% of the taxable pool and still faces the identical tax rate at withdrawal. Here's an observation worth sitting with. Your financial advisor will tell you with complete confidence that your 401k represents a retirement asset. What he will not explain is that the IRS is a silent co-owner of roughly a third of every dollar inside it. He will charge you 1% of total assets annually to deliver that incomplete picture. And here is where Marcus's subplot reaches a resolution that carries real lessons for everyone watching. Marcus had that outstanding loan. The market crashes. His account falls from $568,000 to $340,000. Simultaneously, because his employer begins cutting overhead, Marcus gets laid off at 61 years old. This was not his plan, not his chosen timeline. He gets pushed off the departure board before his flight was ever scheduled to depart. He's forced to file for Social Security benefits early. Annual Social Security benefits are approximately 57% higher when claimed at age 70 compared to claiming them at 62. By filing early, Marcus permanently locks in a dramatically reduced monthly benefit for the remainder of his life, stacked directly on top of the crash damage already done to his 401k. This scenario is not unusual.